The key to managing risk is not to avoid it, but to understand it, embrace it, and manage it effectively. And that is from General Stanley McChrystal. With that said, welcome to the House Einstein podcast. This is House Einstein podcast 67, and I'm your host, Osman. I helped found the House Einstein brokerage, and with me is Hamish Crab.
Hello. I came on about 3 years ago, and I helped the brokerage out behind the scenes, and excited to be on the pod.
And here we go.
Yeah.
I will mention for those that are just listening that I am not in my normal space. If you're watching this on YouTube, you can see my background looks a little different. I'm actually at the office today, and this is a good test of a potential mobile recording studio, because sometimes we have situations where I can't be at the home office and we want to be able to record the podcast no matter where I am. So this is the first remote podcast recording we've done, and hopefully the sound quality and the video quality is great. And if so, we'll continue to do it this way.
Yeah, that's right. It's there's like a little bit of reverb, but I don't think it's the worst thing. And I haven't mastered it in post, so I'm not 100%. It could be fixed.
Yeah, well, we'll see. There are new tools for managing sound, or should I say editing sound? What do you say, Hamish? Mastering
yeah.
sound? Yeah. So the new AI tools are pretty powerful. You all right?
Yeah, I got a scratch in my throat the moment we hit record, and I was drank a little bit of water, and I've been trying to breathe it out, but yeah, just got to cough it through.
Well, don't choke on. Don't choke.
Yeah, no kidding.
All right. Well, welcome to the podcast. In this podcast, let me walk you through what we're going to be talking about today. And our core topic is a discussion of scenario analysis when it comes to real estate investing. Base case, best case, and worst case. And then we will talk a little bit about market conditions using the latest data from the city of Boulder in January, which just came out. For a few minutes, we'll do our very quick, shameless self-promotion segment. And then we'll segue to sales of the week. We only have 4 of them to talk about this week. There's some exciting new news, including Boulder's just announced news about selling its North Boulder complex, as well as an article that I think is very relevant from the Wall Street Journal regarding real estate negotiations. And then we've got a couple of carve-outs. So that is our topics du jour. As always, this podcast is entertainment. If you are thinking about buying or selling real estate, don't hesitate to reach out to us at House Einstein. We are more than happy to be of service to you. And if you are a client, that's the best way to reach us. If you are just listening to this podcast or watching it on YouTube, it is entertainment. Period. It is informational and it is entertainment, but we are not your real estate advisors. Please contact your real estate professional or reach out to us for advice, particularly if you happen to be here in the Colorado market.
Nailed it. Yeah, I think.
Thank you.
We are a entertainment podcast first and foremost, and then if you want us for our business, reach out and call or check us out at houseeinstein.com.
Yeah, that's where to find us. And I've been in the real estate business over 20 years. I'm more than happy to be of service to you. We also have other great agents as part of the House Einstein team. We cover different geographies and maybe slightly different specialties, but we are all alike in our mission, and that is to help you make a smarter real estate decision.
This podcast is sponsored by House Einstein. We serve buyers and sellers in Colorado, focusing on Boulder, Denver, and several mountain resort towns, including Breckenridge and Winter Park. Our mission is simple: help you make a smarter real estate decision. You can learn more at houseeinstein.com or our YouTube channel, where you'll find videos on neighborhoods, specific listings, and much, much more.
Yeah, absolutely. Well, the first topic of today, the closing table, scenario analysis. We talked about this a little bit yesterday, planning it out, and I think it's something that's pretty familiar to you in the investment world, and to me, it makes sense on like a kind of a surface level. But yeah, could you kind of bring it in, and I'm hoping I can riff off of you for this topic.
Absolutely. Thanks, Hamish, for teeing that up. And this is a practice that I first got involved with in the investment world outside of real estate. Prior to becoming a real estate agent, a realtor, an employing broker, founding my own firms, I worked for investment companies, a large family office in Denver. I worked in New York City for a boutique investment bank. I also did some economic consulting in Boston for a brief period. And my role at those stages of my professional career were much more in support of key decision makers. So I frequently was tasked with developing a financial model and then being part of the team that presented the investment to what often was investment committee or key principals of the firm to help them better understand the pros and cons of a particular investment or divestment. And there were also originators that were part of the last company I worked for in Denver that were effectively as almost like sales guys, right? Like they went out there and found investments, deals, and then they pitched it to the owners of the company, the principals. And I was on the principal side, right? We didn't work for the origination side. So the principals would ask me to rebuild the model, look into something different, model a different scenario. And one of the things we frequently did, or I was asked to do, was help them analyze the investment from both a base case, what you expect to occur, and then a best case, like what's the best case scenario for this investment? And usually that lined up pretty well with what the originator was trying to say, because the originators, remember, would get
They're trying
paid.
to sell it, yeah.
Well, they would get paid, like a small component of their comp was salaried, and then the rest of it was bonus, which was usually 3 or 4 times their base pay. And the bonus often was paid out after the deals actually were successful, which was a retention ploy by the firm. That's something, a structure, I should say, not a ploy. In Europe, you'd say a scheme, although scheme has that negative connotation in the United States. It doesn't in the UK. But it was very interesting, this best case, base case, and worst case analysis. And the best case matched the originators, and the worst case would be sometimes pretty extreme. Like, what's the worst thing that could happen to us if we did this investment? What are all the bad things that could happen? And just before we really dive into it, I will mention that sometimes these analyses would take weeks, months, many meetings, not just once. Like we would meet twice a week for months, not just one time for one investment. It was, okay, well that sounds good, now go model this. Well, that sounds good, now go model that. And I particularly remember an aircraft division of this company that we were trying to take public, and we had to convert from GAAP to IFRS accounting, which is a little complicated. Basically, Hamish, what that means is US accounting, which is generally accepted accounting principles, to the international standard in Europe for accounting, which had a lot of nuance and differences from the US system. And because we spent so much time in the analysis phase before we greenlit the next step to go ahead and convert the company to European residency and IFRS, we missed the IPO window because the whole purpose was to go public and get a liquidity event for the owners of the company. And we totally blew it because of all this analysis. And I will say that
I was going to ask if that happens. And yeah,
it happened to these guys. And we're talking about easily $1 billion loss. Back of the pencil envelope on the shares they own, the size of the portfolio, they lost about $1 billion by being too slow. So the same thing applies to real estate decisions. Time is of the essence, and the more research you do up front, the more analysis you do up front, the more your market knowledge, the faster you can make these decisions, which is why it's really important to see a listing early. It's really important to understand the market from a desktop analysis perspective. Like, look at the comps, get a better sense of how this market works, see a bunch of properties earlier than you intend to pull the trigger. Like if you think you're going to buy a home in the next 3 to 6 months, you should start shopping now. Even a year from now, you can meet with somebody like myself who can set you up with listing alerts, start to go see properties together, which seeing is a whole different level of due diligence and understanding about the market than just doing a desktop analysis. But there's no harm in starting this process early. And this tool, this base case, best case, worst case analysis was super useful, because when you know your worst case is that you don't lose money, you basically got your money back after 5 to 7 years and you had a place to live, for example. If that's the worst case, well, maybe that's not the worst investment in the world. Just remember that the best case rarely happens. Usually it's the base case. And sometimes there are off the spreadsheet items to consider, like, I don't know, your happiness.
Yeah.
Like, where is your happiness in this analysis?
How do you value your happiness?
Where's your family's happiness?
Yeah.
And one of the most easy ones to think about when it comes to that is the commute time. So my wife and I occasionally are looking at sort of farmette properties, because we may not want to live in the mountains forever. And one thing we would consider trading our beautiful home in the mountains for is one that is in that corridor that's just north of Boulder, that's sort of micro-farmy, has a barn, has some acreage, has water rights, but I really want it to be within 15 minutes of Boulder proper, because otherwise, particularly if it's out east, you are on sometimes busy roads, and those roads are not particularly fun to drive. So I kind of have been spoiled by living in the mountains and having as much space as we do. I'm willing to take an older, more dilapidated house to have that type of experience and then fix the house over time or replace it, to capture that really rare type of property in the farmlands. We need to come up with a term for this, Hamish, because I think one of
our own neighborhood name, kind of.
Well, it's sort of what you need to know, right? We have a What You Need to Know series about specific neighborhoods in Boulder, but the hobby farm north of Boulder, south of Longmont, south of the Ute Highway in particular, along the Front Range. Altona was one of those towns that used to exist, but it's not just that part. You can also head fairly east, almost all the way to Spanish Hills. And in fact, we have a listing coming up that we're going to talk about briefly. Just we're going to tease you a little bit in our shameless self-promotion segment that has some of these characteristics, or at least it's in the right spot.
Yeah. I don't know. You moved pretty quick. I was going to say that east-west migration that happens, the rush hour has some terrible flow through like South Boulder or Arapahoe or those. So it makes sense wanting to stay kind of more north of Boulder than anything.
Years ago, we helped somebody I'm not going to mention their name, but we helped them sell their house in Erie, and they bought a house in Berthoud. And even though the commute is longer, his feedback has consistently been, this is so much nicer of a drive than what he was experiencing east-west. So the north-south, just north of Longmont, and then through farm country along US 36 is just really pretty of a drive and very tolerable.
Yeah, I'll always be, if it takes the same amount of time, but it's filled with either like stops and starts or is just continuous driving, I'll take the continuous driving all day, even if it's like a 5-minute difference. But.
Or in the mountains where it's a pretty drive, you get wildlife, you get views. And so that is also off the spreadsheet. And these are the types of things that a good real estate agent will bring up or should bring up if they're not just trying to sell you a house and get their commission, that happiness is closely correlated to the distance you're commuting. And even if you get to work from home all the time, odds are that you're going to want to go to town. You're going to want to participate in events. If you have children, they're going to be in schools that have events. And your daily drive experience, like when I lived in the city of Boulder, which I did for many, many years, I could easily hop on my bicycle and go grocery shopping.
Yeah.
And if I've got a day with multiple showings broken out, I don't need to come to the office. I mean, we're very fortunate. We have an office in North Boulder. That's where I am right now. But I could just go home in between showings. I could take the dog for a walk. There are all these factors, and that may be another contributing factor, is that at some point we want to have a dog. And I can't be leaving the dog up in the mountains all day while I'm out of pocket like I am today.
Yeah, especially, I'm assuming you'll get a puppy, so there's some training to do there too. But
Absolutely.
Thanks for bringing us back to the scenario analysis. We're looking at it in the sense of real estate, but then now we're thinking kind of a little bit more grand as far as, I think, policy and just kind of how we're going to run this as far as what we think is going to happen the next 6 months.
Hamish, you're so neutral. It's lovely.
I feel like a moderator.
You don't want to say his name. But obviously what Hamish is alluding to is that the new administration is introducing some very aggressive changes. Some, if you're an independent like I am, there are some things that I like, and there are some things I truly hate and abhor. And I don't want to get into the politics of that other than to talk about the potential financial environment, the market result, what's the crystal ball, right? It keeps unfolding. And we've talked about this a little bit, but we're going to kind of break it into best case, base case, and worst case. And we might as well start with worst case and just get right to it, right? So Boulder in particular. So we're going to kind of focus in on the Boulder real estate market, and to a lesser extent, the whole Front Range, because all of the Front Range trades as a primary home market. And primary home markets tend to be closely correlated with the unemployment rate and the general economic environment. Boulder is a little unique in that we have a lot of higher end homes, a lot of people that work from home, a lot of entrepreneurs, and most of the people, many of the people anyway, that live here, maybe not most, but many of the people that live here and have recently moved here are very successful people with resources. And so they are resilient financially to a downturn. They usually don't have to sell. They've planned their lives, and we saw this. I didn't know this, by the way. So I didn't know this when I first moved here. This is one of those things that you learn through time. I've been studying this market for over 20 years. And when I first started paying very close attention to it, we very quickly went into a severe downturn. So 2007 to 2009 was a significant downturn. And I rubbed my hands and I thought, good. There'll be an opportunity to buy some distressed property. And I was much younger at the time and thinking, now's my shot. And I started tracking foreclosures religiously. And this was manual tracking. I had to look up every week to see what the foreclosures were. There was a company, it's probably still around, called RealtyTrack. And RealtyTrack would share the database. They would pull it from the county and look at what they called pre-foreclosures, which are NED, Notice of Election and Demand. It's a public notice to the owner that your mortgage is delinquent, and that starts the clock ticking towards a foreclosure process. It's not actually in foreclosure yet, it's pre-foreclosure. But this website tracked all that data, and I obsessively tracked every county, and then I obsessively tracked the city of Boulder within Boulder County. And what I found was really disheartening for me as a young person at the time, with dreams of buying a distressed property. And that was Boulder County had the lowest foreclosure rate of any of its counties that surround it, by far.
Yeah, I believe
and within Boulder County, the city of Boulder had almost nothing for foreclosures. And I realized that, I asked myself, why is that? And you could closely correlate it to college education, but really it's also affluence. And people that can afford Boulder often have those types of resources, but not everybody. And in fact, we've gotten some phone calls from people that we know that are in precarious positions because of rising rates and adjustable rate mortgages. So there is distress that's starting to bubble out.
Yeah.
Okay. Now, with all of that said, we're talking about Trump, right? We're talking about the White House executive orders, and we're talking about how Boulder has a high concentration of federal employment. There are a lot of federal employees who live here because of the research labs. And we also are at risk with CU because CU gets so much grant money from the federal government. And if this were to disappear, which it very likely could, at the same time as President Trump's policy decisions throw the economy into recession, it could get really bad. I don't think this is a second quarter or even third quarter event, but as you'll soon hear when we go into market conditions, the market is starting off pretty quietly and softly. It's looking like another repeat of the past 2 years with building inventory and flat or lower prices and sellers being required to compete much more aggressively to attract buyers, not in all price points and locations.
Good asterisks.
And property type. Let me be really clear about that. And that's what a good agent does, is help you understand that difference between the general market is soft and, oh, look at this house that's priced right, and how many homes like it have sold in the last 3 years? Oh, 4. Well, you're probably not going to see another one. Versus, oh yeah, it's a cookie cutter, mass-built home out in Weld County in Erie, of which there are 500, and every year 50 of them sell, or whatever the number is, and they're still building out there. So you can easily say, nah, not the right house, and let it go, because the price is too high and you think prices are going to go lower if that's your forecast. So worst case situation, recession, higher interest rates. Like so this company we were trying to take public was a leasing company. And my boss, when he had been asked to, probably the 50th time, to model a really negative scenario, he came to me and he's like, okay, time for another Johnny can't lease model. Which is like, we can no longer do business, everything is shut down, right? It's almost like a COVID-like scenario where for a period of time, the market's totally done. And it's such I have a hard time even remotely imagining, if that's happening in Boulder, what's happening in the rest of the country? And how long is this going to be happening before rates are radically cut and stimulus is re-injected into the economy? Because when pitchforks come out, political leaders and wealthy people start to feel some fear that the government's going to come after their assets. So given the choice, when we're in sort of, the other picture of this is, the other piece to think about, Hamish, is the risk of currency collapse, right? A currency crisis, a debt crisis. Some would say we're already in one, and our spending has gotten so high as a country that we have to do something. And one of the ways out is called austerity, right? Which is the government radically reduces spending in all forms, and that tends to bring out the pitchforks. One of the other options is inflation. And inflation devalues your purchasing power, but most people flunked economics 101, okay? And they think of dollars as dollars, meaning it's a store of wealth, but
value is set, and
And if I get paid $100 more per week and the cost of my normal purchases increases 100, well, darn, things are just getting expensive, but I notice my paycheck has gone up 100. That feels really good. So that tends to keep people happy. But when the price of goods and services are increasing at a faster rate, there's a lag before. It's sort of like the frog boiling in water. They don't realize what's happening. And so anyway, it's possible that we'll see, a perfect storm of devaluation of the dollar, unemployment rising through AI, and unemployment rising because of federal employment is also decreasing rapidly. That's the worst case. And I think we're going to be avoiding that. I think the AI wave of job displacement is, let's say, a year away.
I think it's going to be more localized than not, depending on the industries that it's going to displace as well.
Say more.
I'm seeing that AI is pretty capable as far as replacing, coders and IT professionals. That's what I've heard anecdotally most of the time. But, we talked a lot last podcast about we think we're pretty safe from our jobs. And I think there's also quite a few other jobs out there that are pretty safe from AI in its current form. So I'm thinking, Boulder's got IBM. I know Seagate's there. They've got the NIST buildings. That's, we've heard of the executive orders for federal companies, but I'm thinking of what other industry is in Boulder. Celestial Seasonings there, the tea company. But I'm trying to think of what industries would AI upset, from an employment standpoint.
Transportation.
You think so?
Absolutely. I think it's coming. Companies are investing billions in driverless vehicles. And first it's driver assist technology, which we already have. And it's then shifting to eventually driverless vehicles.
I know there's a lot of year or two, but yeah.
Well, so I was just listening to a podcast where they were talking about Amazon and how Amazon had to train Wall Street to understand it was going to lose money for a decade before it started making real money. And when it started making real money, it really made money. But for the first 10 years, it was losing money hand over fist. And so this is a frame or a lens of analysis that involves timescale. And when you look at the rate of improvement of AI, and you look at the potential displacement of workers in transportation from AI, and you see the early phases being rolled out in certain cities like Austin, the Bay Area. Many cities in the Bay Area have Waymo and other driverless vehicles. I haven't been in one yet, but I've seen them in videos. People routinely talk about them being normal now. How many more years before
Commonplace, but not normal.
What?
Commonplace, but not normal.
Right. Well, it's becoming normalized.
Okay.
But increase your lens from 3 to 6 months to 10 years. In 10 years, I'm very confident that a large number of transportation workers are no longer going to be employed in that industry, in that sector. They'll need jobs in other sectors. And what those sectors will be are yet to be discovered, but there is the potential for significant employment reduction, which means
through RTD and
increase, right? So we are effectively at full employment right now, and we have been for a while.
Yeah.
Although some have shared with me the difficulties in finding a job, but I think that's relatively recent, like in the last 2 years.
And prior to that, in the tech sector too, yeah.
Right, well, particular in fields in the tech sector, right? You're done. Good luck finding an entry-level computer programming job because AI does that, and the manager can just plug in, what do I want for code, and then it spits out, and it's going to be faster and better than what an entry-level coder can do. So entry-level coding jobs, I think, are already toast.
Yeah.
So the scenario is worst case, okay? You have decided to, let's say, buy your real estate asset here in Boulder, which historically has been one of the safest real estate markets in the country, and you actually are living in this asset too. It's not an income property for you. Well, historically, real estate floats with inflation, and it doesn't have the volatility of the stock market. You could be, buying other investments, right? You should always compare the investment to alternatives.
And also never one egg in the basket either.
Well, diversification is really important too, but you can't diversify your living situation across 15 houses and spend
be a mess.
One day every 2 days a month in each house. Like that doesn't work that way. Most people, once they own real estate in particular, have very little desire to return back to renting, and those are sort of the options, right? What's your third choice? Rent, buy, or be homeless?
Yeah.
Right? So kind of limited choices for replacement goods. In my mind, the worst case scenario is that you lose purchasing power by having put capital in the real estate asset, assuming it's your primary home purchase. If it's your secondary home purchase, it's slightly different analysis. And after 5, 10, or 15 years, you are getting capital back out. But because the reasons that Boulder is an attractive place to live are almost fundamental. They are based around fantastic weather and a population of extremely healthy, athletic people that are going to be supportive of your goals to get outside, get on the trails, get on your bike, enjoy the sunshine.
And infrastructure to support it too, right? Proper, decent city planning, all that to it.
Fantastic bike path, world-class bike paths, world-class trails, and weather that makes it possible to get out there and enjoy it quite often. So the fundamental thing, and taxes are still relatively low to most of the rest of the country. And even though we complain about city council and its management of the homeless issue and its intense desire to densify, even in 10 years, Boulder will probably still be one of the most desirable places to live in the country.
Yeah. The fundamentals, right? So
well, the fundamental drivers of demand, why people would want to move here, probably aren't going to change much in 10 years. However, there could be significant displacement in jobs. We could see a short-term recession. We could see a war with China. I mean, there are all these different scenarios, right?
I know, it's like, which worst case do you want to pick up?
Right. But how do you get away from the fundamental need of a place to live?
Yeah.
I think this is a human need. It is not, in fact, I don't agree with the progressives on many things, but I do agree that housing for our citizenry should be a priority for our country. It's not a problem the city of Boulder can solve. It's a problem that could be solved nationally and federally by making sure that we don't allow homelessness to happen. We have housing for everybody. They may not like where they are. They might be in Wichita, Kansas, or sorry, Wichitans. They might be in the middle of nowhere, Missouri, some small town in Missouri in, what looks like a Soviet era.
But have housing options available, right?
But have something where they have a roof over their head, they have the ability to do productive work, and they have the ability to feed themselves and get some health care. I don't think, I personally, I think that is something.
You radical Osman, how dare you?
I'm a conservative in some ways, and I'm extremely liberal in other ways.
It's almost like people aren't black and white, right?
I'm also independent. Well, I'm brown.
Yeah, there you go. I don't know. I won't self-describe, but
you're a pleasant tan, Hamish.
Thank you. I'll take it.
So,
say Boulder loses all of its CU. I have a hard time thinking is going anywhere, or NIST, or from the multiple other federal organizations that are in Boulder that kind of are, I don't want to use the word backbone, but a very strong supporter of Boulder's employment. Say that goes, but there has been some downsizing, but
you could argue that education at the undergraduate level is a bit of a bubble, and education at the graduate level, particularly in certain fields like legal, is absolutely a bubble, where only 10% of the people that graduate, or 5% of the people that graduate with a law degree, earn enough money to quickly pay back the debt they incurred.
Yeah.
So, but think about it this way, right? So let's say it is a bubble. I think the momentum for secondary, for college and graduate education, the system, is so firmly entrenched that it would be very difficult to disrupt. People expect to go to college. Many people in this country expect to go to college. You are an exception, and frankly, an intelligent exception, because you don't need to go to college to learn very marketable and meaningful skills.
Yeah.
However, most people want to send their kids to college.
I think, the rhetoric on that I've been hearing back and forth is, I think it's just going to be a continuous debate. But that's generally the, you go to school, you go to college, you get a good job. That's kind of the idea or the path. But I have heard a few, maybe it's my age group or something, but people are saying, no, go to a trade, or college is now becoming overpriced. And whether or not it's a bubble, I don't think it's going away, and especially not CU, which kind of has its prestigious status to it, and it is so ingrained to Boulder. I think, I could see it maybe downsizing a smidge, but you've got the CU South project going. CU is huge.
CU spends money like a drunken sailor when it comes to development, and that's just.
I like that. Yeah,
that's just how it is. It's been that way for a long time, and I think their investment scheme, if you will, has been, if you build it, they will come. And so they take out bonds, and they've got a regular and very reliable income stream to keep, like almost a mandate to expand. Yeah. And there's a lot of systematic momentum within the university for expansion. And that expansion results in more students living here and more people that want to stay here, frankly, after they graduate. So the worst case analysis, you still need a place to live. You're going to be living in a fantastic. At least you
have end of the day, right?
If you didn't overpay for the house or stress yourself out financially on monthly payments, hopefully you are comfortably buying something. You should never buy something you can't afford. And the worst case analysis is you own a great asset that for a short period of time is maybe illiquid. And that's happened at various points in time. Like right now, I would argue the $3+ million category is relatively illiquid. The most attractive homes are selling if they're priced right. But 88% of homes that were on the market in the fall were available and into the spring and not under contract. So these are homes that are going through a come to Jesus adjustment in terms of the seller's expectation of the sale price, or the seller's expectation of having to do some work to actually sell the home. It's not just about price, it's about condition and really tracking the competition. So worst case analysis, that's important for each individual to do for themselves, because maybe their job is at risk versus maybe not at risk. So let's say you are a mental health professional in Colorado. We know that the demand for psychiatrists is really high, particularly child psychiatry. I happen to know a little bit about that. And there's way more positions than could be filled in certain fields in Colorado. If you have a job like that, then you really don't have a lot of risk. Even in the worst case scenario, you're living in a fantastic community that may have a short-term disruption to the real estate market, but eventually will likely come back. And if we're in such a place, imagine the scenario where Boulder is not an attractive place to live. What are the things that could occur? A major fire burns all over the town. There's a nuclear attack. Like, if these things are happening,
like industrial runoff, but from what? Like Suncor just starts routing it over to us. Or?
Gravity has, like, have the poles shifted? Like, what level of disruption has to occur for the worst case to happen for you in Boulder real estate? And if that's happening, the value of your real estate asset is probably the least of your concerns.
Yeah. No, I agree. I was like, the only one I can think of is like crime, but I don't think we'll ever see like LA levels of crime in Boulder. I think Boulder's just too small for that.
Boulder's just too small. And we have a
I'll
winter.
eat my words in 15 years, but for now.
Maybe. I hope not. But we have a winter. And winter is really not a pleasant place to be living on the street, doing drugs, and suffering mental health issues. It's much nicer to be somewhere warm. And even people suffering mental health issues often have the ability to get themselves someplace warmer over time. So that's why LA has got such a large homelessness problem, is not just mismanagement, but because it's such a beautiful place to live from a climate perspective.
Yeah. And I mean, there's housed crime too. I know here we think crime and unhoused too, but just in general, I think, there's socioeconomical happenings that influence how many people feel compelled to go commit crimes, especially when life gets harder and they are trying to keep a roof over their heads or keep their families fed or, that kind of thing. But Boulder, with its baseline affluence, I don't think we'll even see that. Like you said, people tend to hedge themselves fairly sensibly in Boulder.
Yeah. I mean, we could break the social contract at the national level and thereby increasing riots and crime across the board. But I don't think that would be isolated to just Boulder. I think that would be systematic to the whole country.
So it's like worst case, if it's happening in Boulder, it's got to be real bad everywhere,
Right.
Yeah.
I mean, most of the time, if you're down on Boulder, just go travel somewhere else for a little while and you'll realize how magical Boulder is, at least within the United States. There are certainly very pretty places everywhere in the world.
But in the U.S.,
In the U.S., Boulder has to be one of the top 5 places in the country to live. Certainly some of the resort markets, that's a different thing, right? When you're talking about Aspen and Vail and Breckenridge and Telluride, or if you're outside of our local market, you're talking about things like Jackson Hole and Nantucket. That's a whole different level of affluence and escapism, and it's almost to the point of like building your bunker in New Zealand.
Microsphere, yeah.
Right? So I think is very not real, there is that analysis, right? Like if you're spending 5, 7, 15 million, there's a listing on Sunset, I think. You've got a lot of alternatives and certainly a lot more risk if you're at the higher end of the market. Okay, so we've hit the worst case.
Yeah, and quite in depth, I might add.
We're having kind of a fun, in my mind, Johnny Can't Lease scenario analysis. Like worst case, the world is ending. How's your real estate assets in Boulder doing? Probably not even of concern if it's gotten that bad. But we certainly could have short-term disruptions. That's more realistic as a worst case, with a recession, with job losses because of all the federal dollars that flow into Boulder. And there could be a little bit while Boulder has to have an adjustment. And that adjustment, if it occurs, is probably more toward the upper end of the market than the mid and entry level.
Yeah. As the last pod, we talked about the availability versus price segment, and you've hit on it a few times this pod, right? Fairly illiquid over 3 million. So,
and very illiquid, and under $1 million, extremely liquid, as long as you didn't buy something stupidly. And I want to just be blunt about that. Like, I've never seen a Martin Acres ranch that didn't sell, provided it wasn't right up against a busy roadway like Table Mesa, or backing to the highway on Moorhead, or on Ash, sitting there right next to Broadway. That sort of stuff can be very stagnant to sell, can be very difficult to sell, slow. But the rest of the neighborhood sells very quickly unless you just absurdly overprice it, because it's the most functional entry-level house you can buy in Boulder at that price point.
It's the beginner neighborhood,
It's the starting point in Boulder real estate. So, I mean, baseline, you could argue, is also really the starting point. But
I'm thinking, like, when I think Martin Acres, I think of the ranches. And so it's kind of just anywhere that's got those ranches.
Yeah,
I think
that's why I did the Martin Acres Index, and for many years maintained it until the volume of sales got so low that it was almost irrelevant.
Sample size, right?
When I first started, there were 10 to 15 sales per year that matched the index of the entry-level house in Boulder. And then as time went on, it started dropping to like 3-4 sales a year. Baseline is another entry-level neighborhood, but it has such high student density that I usually just say, just skip a step and go right to Martin Acres. But Baseline is a great neighborhood.
Yeah, absolutely. So base case.
Okay. So what do we expect to happen, Hamish? What do you expect to happen?
For our market.
Yes. I mean, you could start big picture with how you think things are going to play out. But then let's drill down to our market. And also I want to bring in that our market is not just single family houses. We have a large number of condos and townhomes. In fact, more people who live in Boulder are renters than are homeowners.
Depends on which side you sit. I'd say, considering the kind of cut down on federal workers, we will likely see a few more listings in the future coming up of people that do need to sell out of necessity or job shifts. I think we could also expect to see a few people leaving the country as they start to see things going south. They might not want to be here. So I could see we'd get a little bit more inventory as we've already had. From the rate environment, the current dynamic, at least the last time that I read, between Powell and Trump, they aren't too friendly between one another. So I don't necessarily know, aside from Trump causing either a bunch of inflation, if rates would swing one way or another, aside from what Powell's targeted goal is. So I imagine, like right now, there's still a bit of pain as far as buyers go to looking at finance costs and what current list prices are for most homes. I don't know. I think we'll see a little bit less liquidity in Boulder. Of course, like below 1 million, we'll still see a lot of
When you say less liquid, so let me just get clear on terminology.
Yeah.
Less liquid, you mean less sales volume?
Yeah.
Okay, got it.
Yeah, and like, I mean, too, under the $1 million mark, I think it's going to be a little bit harder to sell a home just because of larger factors. You know, we do see the odd cash deal here and there in Boulder, but especially those entry levels around the millions, it's usually a loan, and it's usually maybe they've wrapped in and they're using equity from a home previous, and now they're getting into the Boulder market. But yeah, I think we'll see a little bit less activity all the way around. I had more, but now I've forgotten.
That's all right. Yeah. Well, Powell doesn't set the 10-year Treasury rate.
Right.
He sets the discount rate, and the market sets the rest of rates. And the U.S. is beholden to the rate environment that we can sell our notes and our bonds for. Mm-hmm. And a large portion of our debt is coming due, including this year. I think I saw something like almost 25% of our national debt is due to be refinanced in the next year or two. It was a very large number. I can't remember the specifics. But the reason I'm bringing that up is that, yes, the discount rate sets the beginning of the yield curve, but the market sets the rest of it. And the market cares about alternatives for where else it can put capital to work, where else it can invest. And this is why gold is shooting through the roof. This is also why other currencies adjust every minute of every day relative to the US dollar. So where investors decide to put their 10-year risk-free money what they think it should demand as a interest rate is all about the risk premium that is placed on that, right? Like, so the risk involved in having money out for 10 years, although rarely do people keep their money in the asset for 10 years, but that's what that rate reflects, is the risk. And so I think that rates, if we are in a recession, will come down, and rates are, those payments are denominated in dollars, and the other option, well, one of the inflation option is to have the government just issue more and print more dollars to pay it back, which devalues the dollar.
Yeah,
which
but
is
not
inflation.
Uncommon in either administration we've had in the past 8 years. So
It's and that's inflationary.
Yeah.
And then you have to put rates higher to keep inflation down, and so we're in a spiral, right? We're sort of in a trap there. That trap can be broken by a variety of ways, but big picture, I like to think about how the U.S. compares to alternatives. And you mentioned people leaving. It's very difficult for people to leave the United States and find a better choice. That if they happen to be citizens here, they don't necessarily have the option to fly off to a different country. And their lives are here, their families are here, their businesses are based here frequently. It's a very small number of people that have dual passports, that have rights to go to New Zealand or Australia. And if they're just going to Canada, or they're going to, Spain and Portugal are good expat options. But it's very, very small numbers of people that actually can do what many people talk about wanting to do, particularly in your demographic.
Yeah. I was thinking maybe Boulder's got a bit more affluence. But then we've got to think too, like Colorado is fairly sheltered, I think, from the worst of class differences too. And so being that we're a little bit more affluent of a state, and then we are a little bit more progressive, I could also see more people moving here from out of state and other places that are seeing themselves not enjoying the influx of maybe more conservative policies.
And I agree with that. That's analysis, I agree completely. Migration within the United States for political reasons and ideological reasons is likely going to increase. It used to be for, I think, creative reasons. Like, people wanted to live with other creatives, and they also, of course, wanted to live in nice weather. But I think that people fleeing the ideology in the more conservative states, we have already seen an influx of clients that don't feel safe living in Florida, don't feel safe living in the South, and they want to live in a place like Colorado, which is way more accepting and still very dynamic from an economy perspective, and taxes are relatively low here for now.
Tabor, right?
Well, Tabor, and also not having legacy costs associated with the development of that state. So New York, for example, is a much, much older state and has, much stronger teachers union, decades of public workers and pensions to fund, and Colorado has not been a state that long. We don't have the same legacy and that we didn't go through industrialization the way that New York did, and the population here is much smaller. So, all right, back to base
That's
case.
cool.
We're
Good
kind
points.
of rambling.
Yeah.
Say that again.
I said that's cool. Those are good points. I'm going to look up the legacy cost thing because that's interesting to learn about.
I mean,
I never even thought of it. Yeah.
I grew up a beneficiary of it. In addition to many other things, my dad worked for the state of New York and got a very nice pension from the state of New York, including healthcare costs for the whole family, and a very decent pay package from my understanding. It wasn't quite as much as he would have made in the private sector, but that pension and that health insurance program and all of that, and the lack of stress in the job, when he had his private practice, his office was like paperwork everywhere. And when I visited him at his office at the state, he had toys, he had books, he had like, what do you do here during the day? It was very clear that
you even work, dude?
goofed off a lot, in my opinion, and hopefully he's not listening to this. And I'm going to see him in a few days. But he, in my opinion, he had a lot more chill time in his state job than he had in private practice. So my analysis, Hamish, is that, or my forecast is that nobody knows for sure what's going to happen, but I think that there's a very good chance that there will be a short-term decrease in employment, but it may be offset by the economic wave that could result from deregulation. And the US has a lot of regulations that make it uncompetitive to manufacture, that make it difficult to build businesses. And the current administration has promised to clean a lot of that up. And I, by the way, I believe in regulation, but the fact that these regulations don't sunset by themselves, they just grow more and more and more regulations to the point where you're just tied down in regulation. You're unable to do anything of size. And one of the ways to look at that is the comparison between what it costs to build infrastructure in China compared to what it costs to build infrastructure here. And low labor costs are only just part of it. It's the cost to comply with excessive regulation. And again, I say this as somebody who cares about the environment, somebody who cares about worker safety, but having tried to get something permitted in the city of Boulder, having gotten things permitted in the city of Boulder, and watching many clients get things permitted in the city of Boulder, the delays and the costs associated with that. Even just, there's a restaurant in town called Torchy's, and I hope it survives. It's where Bojo's used to be on 27th Way, which you could argue is a cursed spot. It struggled. Even Bojo's failed there. And this new restaurant, Torchy's, was a food cart, and they opened up before
Shreddies, not Torchy's.
Shreddies. Oh, yeah. Shreddies. Yeah. All right. Shreddies. Sorry, Shreddies. We're talking about Shreddies. They were without a liquor license for many, many months. I think almost a year. And it was just brutal. I can't even imagine trying to operate in the restaurant business without the liquor revenue. And that is 100% a delay caused by regulation and the process to get licensed issued. So that economic boom could offset job losses. But in the longer run, the 5 to 10 year horizon, for sure, there's going to be job losses from AI. And but there could also be all new industries and all new jobs created. It's going to be a very dynamic time. And my assumption is that that this year we're going to see another flat to down year, particularly
I would agree.
At least until summer. And then fall and winter are usually the slow season. So if you're a buyer, you're very lucky to have high inventory and selection and lower prices and more leverage to negotiate a better deal in the late summer and early fall, and maybe even into the winter. And if you're a seller, well, you better the good times aren't here again. You better really be dialed in, particularly in certain price points and locations. That's what I expect is going to happen. And then the best case scenario, the Goldilocks, best bowl of porridge, like not Goldilocks, but this is like the rose tinted glasses. What's possible? What's possible is a magic, like we'll have low rates again and full unemployment. There'll be no job losses, and this is like the 1950s or 60s.
The deficit's paid off.
Right. Anyone can have a job that wants a job. The government's sovereign wealth fund, by nationalizing Greenland and taking over the Panama Canal.
That's best case for you.
And making ourselves the AI haven of the world. We're going to generate so much magical wealth that will be like Saudi Arabia. Everyone gets, their $100,000 a year job guaranteed, full health care, no taxes, right? Like this is the magical income scenario. What happens to real estate in that scenario? Well, Boulder becomes, even better. Like Boulder solves its homelessness issue. We no longer have litter.
Becomes less dense somehow. Education
is free. Yeah. And guess what? Boulder's still an amazing place to live, and your real estate asset is still really valuable. In fact, even more valuable. And those sitting on the sidelines really screwed up by not buying as much real estate as they could during this slight downturn period we're currently experiencing.
Yeah. Sure. Best case, right?
Yeah. But in all seriousness, this analysis in the general way is not that useful. What's really useful, and it's fun to imagine best, worst, base.
Good thought experiment, yeah.
Right, it's a good thought experiment, but really when the rubber meets the road is for an individual that's thinking about buying or selling a real estate asset. And we recently met with a client who was trying to make a decision between selling an investment property that they've owned for many decades as a family, or selling their primary home and downsizing it. That's sort of, neither of those are attractive as choices. It's like, can you keep both was my recommendation, because I'm a believer in Boulder real estate. What's the third choice here? And often what we are advising people on is whether they should pursue a house or not. And we look at the last 12 months of sales as a way to help them feel more confident or less confident in their decision. Because when we're writing an offer, there's a lot of emotions, there's a lot of stress. This is the home that they really wanted, or maybe they don't, or maybe one of the two wants it, or three, who knows how many people are involved as key decision makers, and other people in the family or the buying group don't want it. And when the emotions are running that high, it's really important to pause and do some mental thought experiments. Like, what if you wrote this offer for 10% over list because you heard there was another offer coming, which is what the other side is telling me. It may or may not be true. It probably is. And you decide, I gotta have this house. You go 10% over. You take away all your protections on inspection and your contingencies. Against my advice, I tell you not to do these things, but this is what you really want to do. And then the next morning, you find out you got the house. How do you feel the day after that? Do you feel
fleeced?
Regretful? Do you have buyer's remorse? Or are you still excited? Have you ever won something on eBay or in an auction and instantly regretted it? You're
never auctioned, no.
Oh no, I bid too high. You've never had that?
No, I haven't auctioned.
You never bought anything on auction on eBay?
Mm-mm.
Really? Okay.
Yeah, well, I just buy now.
Right. Well, buy now makes it a lot easier, but before there was buy it now, there was most things were auctioned. And there's an excitement in an auction, in real life or online, that buzz can drive the price high, but it also dramatically increases the chance of buyer's remorse. So
makes sense. Caught up in all the action, all the excitement, and
so the tool is, imagine the day after tomorrow when you have been successful in getting the home for the offer you wrote. Are you thrilled or are you regretful? Because if going $1 over your maximum price makes you feel regretful, like you violated your own discipline, then you should not write that offer now. And if you've done the best case, worst case, base case scenario for your personal situation, and you can live with the worst case, well, you should consider moving ahead. Because if the worst case isn't so bad, and the best case is amazing and rosy, and the base case is pretty happy, then what's the worst thing that can happen to you if you buy this piece of real estate in one of the safest real estate markets in the country? And as far as selling goes, everyone knows my bias, which is don't sell ever. And if you have a crappy real estate asset, you sell those in really good times, and you then turn that money and buy better performing real estate assets. And don't forget to evaluate your happiness and your commute times and your marriage durability for not making this decision to buy. You have to, sometimes people really need to sleep on it. They need to consult their family. They need to consult their spiritual advisors. They need to maybe have a moment of meditation or prayer, like whatever, stare at the salt lamp, whatever you need to do to feel like this is right for you personally is really important to do. And we're more than happy to give you the data and give you the negotiation experience, but you will ultimately make the decision on the price and the terms of the offer. Speaking of which, we need to check on one that's going out today. So we're almost at an hour at this point, so we need to stop on this topic. All right, let's move on to market conditions. And in this segment, we typically just focus in on one particular angle or lens when we look at Boulder and its real estate market, or Denver, the whole Front Range. Sometimes we specialize on certain cities. In this particular case, we just got the data for the city of Boulder, single family houses, and we can kind of walk you through what happened in January. So we just got the data for January is what I'm trying to say, and not saying it very smoothly. So let's jump in. So this walkthrough of last month's data is just for the city of Boulder and just single family houses.
Oh, it's COB.
COB.
Yeah.
That's right. The Cobb. And last month there were 122 new listings on the market. That's an increase year over year of almost 36%. Overall inventory, there were 188 homes on the market, an increase year over year of almost 13%. As far as pending sales go, there were only 42 pending sales last month, and that is a decrease of 26%.
You said 42 pending last month or 42 pending last year?
Sorry, 42 pending in January. Okay. What did I say?
You said 42 pending last month.
Yeah, last month is January.
Oh, yeah.
We're in February, Hamish.
Yeah, we are. Come on now.
Okay.
Double check all the dates on the contracts.
Double check. It's 2025 and February.
Yeah.
So there were 42 pending sales last month. That's a decrease of 26% year over year. And then closings. Only 39 single family houses closed. And that's a decrease of 11.4%. And when you look at prices, everyone wants to know what's going on with prices. Frankly, you should ignore median price in the city of Boulder. The volume is not high enough for that to be consistent. You're going to get a volatility that is based on a small sample size, not based on the reality. It's better to look at dollar per square, and the median sold dollar per total square foot was $4.39 in the city of Boulder last month, and that's a decrease of about 4%. So, what is this pointing to? It's pointing to a slow January. I guess we can quickly do attached dwellings as well, Hamish, since we can ramble through so quickly.
Here, yeah.
Attached dwellings are townhomes and condos. A shared wall is involved. And for new listings in the Cobb, in the city of Boulder, there were 73 new listings last month. Keeping in mind, a lot of these are refresh listings that have come back after being withdrawn from December from last year. The total number of homes for sale that are attached dwellings, 170. That's a 79% increase year over year. As a percentage of, homes that are in pending sales, homes that are under contract, i.e. pending sales, there were only 38 pending sales. And that's actually an increase compared to last January of a 12% year over year increase. And then closed sales. 32 condos and townhomes sold last month, and that's an increase of 23% year over year. And finally, let's talk about dollar per square. The dollar per square, the median dollar per total square foot in the city of Boulder for attached dwellings in January 2005 was $450, and that's a decrease year over year of 11.4%. So the most concerning thing is the sheer volume of new listings and total homes for sale being 52% and 79% year over year compared to January 2024. And meanwhile, closed sales did rise. We saw a 23% increase year over year. We still only saw 32 houses sell, and inventory being 170. Well, that gives you 32 over 170, Hamish. You can,
I got you here.
Yeah, you can do the math on that. It's a small percentage. It's not a balanced market between
18%.
What is it?
18.8.
Yeah,
19%.
So
yeah.
roughly just under 20%, and that represents about 5 months of inventory. And actually, that is considered a balanced market between buyers and sellers. But Boulder is not normally a balanced market, and so it really, for most people, that sort of dynamic with 5 months of inventory available really feels like a buy-side market. Like you have a lot more leverage, a lot more selection, and you should expect your house, your condo or townhome to take significantly longer to sell. So that's the quick and dirty walkthrough of Boulder market conditions. Questions, Hamish?
I'm glad you hit the month supply. I was going to ask on that, and that's kind of, it's not like a golden rule, but it's where you do gauge buyer seller market, or where we have in the past. So, well, Boulder is a balanced market, huh?
You may have noticed a little bit of hedge with my language there, and the reason is that it's really not right to look at current sales over current month inventory. You should be looking at current sales over preceding month's inventory. So if there were 50 sales in January and there were 100 available homes to buy in December, well, that represents roughly 50% absorption of the market, or 2 months inventory in December, if January were straight lined. But January demand won't be straight lined, and inventory in December is relatively low. Real inventory is what you start to see in May and June. That's like peak inventory. So it's, months of supply is disingenuous, because when you hear months of supply, most people think of a flat line in terms of demand, and that no real estate market is flatlined every month in demand. We're very seasonal as an industry.
Yeah. Okay. Makes sense.
So you'll hear me use language that's a little bit squishy, a little vague, because I'm uncomfortable with dishonesty.
Absolutes. Yeah.
And unless I can back up what I'm saying with a clear analysis that makes sense, I'm very hesitant to say this is how it is. And that's true whether we're talking about the overall market or a specific purchase that you're thinking about making, or a sale that we currently have 3 listings under contract, and with one of them, the client was a little concerned that things are going way slower. What's going on? And I had to show him the data. Like, the data is that the market's really slow overall for attached dwellings in the fourth quarter. We knew that going in, and I know we're priced right. I know we're marketed well. And I showed him each agent's feedback.
Like quadruple checks too, yeah.
Feedback reports, and made sure on all of these things that we're right. There's nothing wrong with this place. In fact, we're kind of the only game in town when it comes to wanting something in this location with these features under $1 million. We frankly are the only game in town. And it's a great place, so no surprise that one is headed to closing.
Yeah. And knock on wood at the other 2 as well.
Well, knock on wood, they're all head to closing.
Yeah.
We often tell our clients that even though we are under contract, even though we're through inspection, even if we're past appraisal and through inspection, anything can happen in real estate. And the buy side of the deal has all the exits. And they may choose to use one in a disingenuous way, and it's very difficult to prove that's what they're doing. So a dispute over the earnest money, you're not selling the house to somebody else if you're arguing over the earnest money for years. So it's a lose-lose for you when a buyer is disingenuous and wants to exit. So you never know until closing. Like, once you
no celebrations.
No big celebration until the closing is complete.
Yeah, you can maybe have a sigh of relief when you go under contract, but make it little.
I mean, I told you about the deal with the client with all the stuff in the moving truck, and the sellers arguing, the divorcing sellers fighting in the closing room.
Yeah.
And us discovering that one of those 2 sellers were not on all the contracts because the listing agent told us they weren't part of the deal. That the other seller lied and said, no, my ex-wife is not on title anymore. And somehow we missed this all the way to the closing. Well, we, being the title company, missed it all the way to the closing. We're not, our job is not to verify who's on title. That's the title company's job. But man, all the way to closing, and at that last minute, it could have blown up.
Yeah, that would have been a white knuckle right to the end.
I was in a moving truck on the side of the highway, driving to Burning Man, negotiating this and writing contracts to fix it.
That's not the first time you've been pulled over on the way to Burning Man.
It's just expected now. It's like you need to just prepare to pull over. But now we have Starlink, so life is so much better. Mm-hmm. Okay, let's continue, Hamish. That is our market segment. Time for shameless self-promotion. This segment is where we touch base on a buyer or seller need that we're currently working with, and a buyer or seller that we're currently working with and their need or their situation. And we have a really exciting new listing coming up out in East Boulder County. And I'm particularly excited to work with this client because they are so straightforward and thorough and conscientious. They value the work we do, which just makes us want to work even harder. And this is the 3rd deal, I think, with this client. Maybe the 4th deal with this client.
I think we're circling 4, yeah.
Yeah, I think this might be deal number 4. And so this is a lovely home out in East Boulder County, but not way out. It's probably only a 10 to 15 minute drive to the city of Boulder proper, along a a pleasant route, meaning you're not stuck on the diagonal all the way. It's a great property. I don't have a lot of details to share with you, but we think we're going to have this on the market in March. Hamish, what have you got you know more about this home than I do.
Yeah, I shot over last summer to take some pictures and video ahead of time. These sellers being as excellent as they are thinking years ahead, right? So I shot over and got some content during full bloom, full summer. And it's a really cool property. I mean, of course we're biased, but driving out there, being close to the Cobb, close to the city of Boulder proper, and then also on the route, you kind of really feel like you're getting this area of remoteness just driving through there. So it's a really neat spot. I don't know how many details can we share. It's
surrounded by farmland.
Large lot. Yeah,
it's surrounded by farmland, so your views are going to be over farmland and spectacular. So if you want that sense of isolation from the craziness of the city, at the end of the day, you want to go home to a place that's peaceful, but still within such a short drive. This could be the one for you. And I'm pretty sure it will be priced relatively aggressively. This is a seller that values our input and analysis, and we will dial in our pricing very, very tightly to make sure it's right. So if you're out there looking, don't hesitate to reach out to us on that one. We're not going to share any further details, though, are we?
Yeah, I think that's case shut and point, right?
Okay. It's time for Sales of the Week. In this segment, we look at notable sales that have occurred recently that illustrate market conditions and a price point or property type or location that is relevant for tracking. In other words, it's a good data point to put in your database. If you're a market watcher and you are thinking about buying or selling, this is an important way to keep track of what's happening in the market. Okay, there's only 4 this week, and our first one is 740 Hutchinson Street in Louisville. And if you're not familiar with Louisville, you should consider it. It's a great alternative to the city of Boulder. It doesn't have college students, or at least any sizable density of college students. It also isn't dealing with some of the social problems that Boulder does. And it also has great open space. In the future, it may even have a train stop. They have identified that location, and we may be getting more funding for that someday soon, who knows? But there is supposed to be a train stop there sometime in the future. And it's a lovely small town. In fact, Smart Money magazine rated it the best small town in America not that long ago, and it continues to win awards. It's got a really cute downtown. And I could go on and on and on. And this particular house is very close to another one of our clients' homes, which is one of the reasons I wanted to talk about it, because it's a great property. It's on a 7,300 square foot lot, built in 2015, 2-car attached garage, 4,357 total square feet, so slightly over 4,000 finished, and plenty of bedrooms and baths to house friends and family, perhaps have an ADU or an in-law apartment. Really walking distance, steps away, strolling or rolling distance, take your pick, of words to the historic downtown. So really nice spot. And the property was listed a little bit on the high side when they first hit the market last summer, which, look, it caught me by surprise too. I no longer hold it against the listing agents because we were caught in the downdraft too on a couple of our listings. And it was originally at 2.1 when it was first listed in June, and then at the end of August, they pulled it off the market for a couple of weeks. It's not entirely clear why. It was brought back again at 2.1, and then 3 weeks later, they cut the price to just under 2, so this is the beginning of October. Nothing happened. The property just sat on market, and now the reason I'm bringing this property up is not just because of its location, and of course the 2 stories and having all those bedrooms and baths. It's because it was in withdrawn status when it went under contract and sold. And we have a listing that's very similar. It will hopefully be closing soon, where a very savvy buyer approached us while it was not actively listed. And acquired the property, and this is something we've been advising our clients to look at and think about, is look at withdrawn and expired listings from the fourth quarter, because you might find a gem in there. And that's what happened here. So it sold for $1,887,000, so more than $100,000 below list, and it didn't officially come back on market. It just went from withdrawn to sold. So this is a case in point for the importance and value of doing that. If you flip through the photos, you're going to see a very nicely updated house. There is, that dark nautical blue, and the cabinetry always looks great. And the photo stack looks fantastic. It's kind of whited out. I mean, that's the look these days. Of course, part of that is overexposed photography, but we're not going to criticize too heavily. This is what people like to see when it comes to real estate photos. And I mean, it's got the little teepee thing for staging, which is hilarious because that's become the staging trope of
that and salt lamps.
Salt lamps are an entirely separate trope. But what a cool property, 2-car garage. I would live there. I would have bought this in a heartbeat had I been looking in the city of Louisville for a personal home. So that is 740 Hutchinson. And the thing it illustrates is the importance of looking at withdrawn and expired listings, particularly in January.
Yeah, right. Here. Great location.
Awesome spot. I mean, you wake up in the morning, go down the street and get your coffee. It's dangerously close to Moxie bread if you're concerned with your waistline, but we love Moxie bread. It might have to be a once a week thing if I live there.
Yeah, no doubt.
And of course, newer, right? This home is only 10 years old. Now, let's put that in comparison with this next house, 1299 South Teal Court in Boulder. And this is just east of Cherryville. There is a little neighborhood called Sombrero Ranch. And Sombrero Ranch has a lot of very large lots and estate quality homes, many of which were built in the 80s and early 90s. And this is a classic example of that. It is a 6,300, almost 6,400 square foot house, over 6,000 finished, 3-car attached garage, and 4 bedrooms, 5 baths. So reasonable number of beds and baths. It of course has other rooms, but it's not just about beds and baths. And this particular home had been on the market for a significant period of time. It was first listed in July at 2.1. And they cut it to just under 2 in September. And then nothing happened. It expired in January. And 2 days later, it was reactivated. It expired the end of December. It was reactivated in January. 2 days later, it was under contract. And the closing price was $1,775,000, which is $215,000 or so, something like that, below list. And that's a pretty significant discount below list. You're looking at 10%-ish kind of range. Not a shocker for a home that had been on the market that long, but a pretty solid buy. Like, I really like this little pocket neighborhood because you're so close to the open space in South Boulder. You're really close to the South Boulder Rec Center, and it's kind of hidden away from all the hustle and bustle of Boulder while still having very generously sized lots. But 80s era or late 80s era construction is evident through all of its design. I mean, just walk around or look at the photos, you'll see the way the windows are done. The overall design of the house is like classic mid 80s, late 80s kind of house. May or may not have had any updates. I think the countertops may have been replaced.
Definitely not the carpet.
Replaced, but the light fixtures, the stove, the little butler's pantry may have a new wine fridge, that sort of stuff. But even the furnishings they left in there for the staging look like they're from the mid 80s.
Yeah, good point.
And the gold trim on the water faucets is always a dead giveaway for that time period. My parents remodeled their house at this time, and their house looks like this.
It's funny, right? It's no longer gold; it's the bronze fixtures and faucets that are in vogue. Yeah,
somebody decided we're doing bronze, and that's what's happening. It has a basement bar, which I don't know, sort of cliche, but people do put some nicely updated basement bars in, little pool table in the corner. You have all that room, and look at the mini pool table. Like, why not have a real pool table if you're going to have all that space? Nice little back patio.
Yeah.
Yeah. You know what's funny about this house is people think that terracotta roofs and concrete roofs are forever roofs, but they're not, because it's the underlayment that actually is providing the water resistance. At some point, those roofs also need to be replaced. So
I bet the inspection process for that is involved.
I bet. It was a cash deal, by the way, which is often how you can negotiate a pretty sizable discount. And it had been on the market a long time. That's the other giveaway for considering offering low with a fast close. And then the last piece is, well, how long have these people owned it, right? Because if they've owned it a long time, they're often much, much more negotiable. And in this case, they have owned it since 2005. So 20 years in this house, and they couldn't get rid of the gold fixtures in 20 years. But I suspect that the seller was much, much more negotiable after 100 plus days, 130 days on market. They were willing to negotiate. So well played, great location, but a little dated compared to Louisville, right? Like, Hamish, if you had a choice between the smaller, nicer house in Louisville at 1.8 and this house at 1.8 as well, 1,775 versus 1,887. I mean, functionally, you're looking at $100,000 difference in price, but I mean, for buyers in this price range, that's not insurmountable typically. Yeah. If you had that to buy a house, which would you rather have?
It's tough. I love the Boulder location, but with the larger house comes more expensive ownership. And then Louisville definitely appears very buttoned up. I think I'd go Louisville, really.
Yeah, me too. Yeah. And we have a client that lives in the neighborhood, so don't take that personally, but I think I would much rather stroll to the coffee shops and restaurants and bars than be out on Old Sombrero. But at the same time, there's some benefits. You can bicycle right into town from Old Sombrero into the city of Boulder, and it's much more peaceful. It's more remote. It feels like you may not even see neighbors that close with lot sizes that big.
Yeah, really cool home. I'm surprised given the size and everything, but it makes sense with it being outdated.
Well, the size thing is an interesting factor because today there are more buyers for the smaller homes, 4,000, than 6,000 plus.
That's true. We've had quite a few clients say specifically, please nothing over 5 or 4 even.
Yeah, over 4.
Yeah.
In fact, I'm having happy hour with one of them this evening, which is why we need to keep this podcast on track.
Trucking along and extend my hello to that client.
I mean, this is the first podcast we submitted an offer mid-podcast.
Yeah, we did.
Okay, let's look at the next property. 1050 Berea Drive. I happen to have 2 clients on Berea Drive, and both of them report that they're incredibly happy with this neighborhood, this street. In fact, they had regular gatherings throughout COVID. I attended one of them. Like, it's a really social and friendly place in close proximity to the shopping plaza and the park and the schools, and it's at a very reasonable price point for Boulder. And this is a classic 2-story house built in the 60s at 1050 Berea Drive, 5 bedrooms, 4 baths, small is beautiful, 3,300 square feet, of which about 1,000 square feet are in the basement, a 2-car attached garage, and a color scheme that is from sort of the 90s. But this is the model in many people's mind of a decent, basic, sizable family house, one that you can own for a number of decades. And this street itself is a great spot. So when I look at the price point, I think this home was a pretty good deal. It was listed originally at 1.55 in October, which, listen carefully, I'm going to say this again, listing in the fourth quarter is a recipe for leaving money on the table. You should strongly consider waiting, because had these people waited, I suspect the price probably would have been a lot closer to that 1.55 list. But instead they didn't, and they listed at 1.55 in October, and then mid-December, which is right when everyone's going on holiday, they cut it to 1.45, and a few days later they got it under contract. And the buyer closed at the end of last month, at the end of January, at 1.413, which $1,413,000 for a very functional family house in a fantastic neighborhood in Boulder. The only criticisms I have of the house, well, there's a bit of power line issue going on, and I'd want to look closely at how that played out on one side of the house. And then I love the front porch, and the addition on the back is really nicely done too, with nice hardwood floors. It's kind of weird to see the laundry in there, but okay.
Yeah.
Those photos are photos those doors are doors I would have kept closed for the photos, but okay.
Yeah.
Some of the light fixtures could have been easily replaced and upgraded to make the home look a lot nicer. The color scheme on the outside would have cost a few $1,000s to fix too, because that yellow color is not particularly attractive. And the kitchen, of course, is completely dated. It looks like it's in perfect condition, but holy cow, that's like late 70s linoleum and 90s era cabinetry, and then the doors open for some reason in this photo. Like I don't know. This home needs some updates, right? Like it's in decent condition, but likely the new owner is going to invest $200,000 redoing the kitchen. Hardscape on the outside.
Safe bet.
Oh, go ahead. Sorry.
No, safe bet on the kitchen. We've seen this logo before on the bottom left of each of these photos. I can't remember which house we talked about it. We talked about it on one of the podcasts, but yeah.
Well, we'll come back to the logo in just a second. The other details are, some bit of datedness in the bathrooms, but not horrible. And then you've got the basement kitchen, which is very likely unpermitted. The cabinetry does look similar, but I would not be surprised if it's unpermitted. That's very common to have an unpermitted kitchen. Yeah. I usually recommend not putting the photos of the unpermitted space in the MLS, lest the city be breathing down the neck of the next owner. And then these photos, this was listed by a well-known local boutique real estate firm, and I don't know why there are logos in the bottom of the photos at all. In fact, the MLS is pretty particular.
You shouldn't be allowed them. Yeah.
They snuck through with somebody's logo on these photos, but none of the logos mean anything. So it's like, it looks like a printer next to the outline of a house. I'm not sure what that is.
I think it's the agency that took the photos, but I'm like, I've seen that one before on this podcast, so called it out.
Yeah, I don't really have much to say about it. It was a cash deal, and there was no additional concession on inspections or anything like that was disclosed.
Great spot.
Yeah 413 seems like a really strange number. I wonder if the negotiations took a while to get
1413.
It.
Yeah.
1413. Yeah.
Yeah.
Okay. Last but not least, 247 Alpine Drive in Nederland. If you've been following my blog long enough, or now our website, and listening to this pod long enough, you probably have heard my investment thesis about Nederland. And the investment thesis goes something like, well, affluent people like to ski and snowboard and vacation, and I-70 sucks. And the suckiness of it is not going to get any less. It's probably going to get more sucky. And so places that offer some of the experience of the Alpine environment without that miserable drive on I-70 are likely going to see significant appreciation, and Nederland is the biggest beneficiary of I-70's misery. And I've talked about how Nederland will continue to Aspenize for the next decade or two. And this particular property was acquired for 1.12. In 10 years, it could easily be double. It would not surprise me, because it is right on Barker Res with views of the res. It was built in the early 90s. It's on a decent amount of land. It has functionally 3 bedrooms, 3 baths, a little small, but not horrible, enough for many smaller groups of people to enjoy. It has a 3-car attached garage. And I mean smaller, like not like by stature. I mean smaller, like a group of 3 to 5 that go up there for a winter skiing trip, or it's a second home for somebody that lives in Boulder. So anyway, built in the 90s. And when you look through the photo stack, you see a very attractive vaulted ceiling, main living area, and you've got that deck that overlooks the water. You could stroll if you wanted to right down to downtown Nederland and enjoy the funky restaurants and shops and bar or two that are down there. And you can easily get to Eldora from here. And there's some great mountain biking trails around, particularly in the peak of summer and early fall. The trails on Magnolia are really fun.
Oh, yeah.
So
Love
what
Magnolia.
a great little spot for a newer era home. There's some funkiness here and there to this house, but not uncommon for mountain homes. And so from a deal perspective, this is what's sort of surprising, is that it had been listed at 1.2 in May of last year, and the market effectively ignored it. Nothing happened. And by September, the seller said, now's a great time to cut the price. They should have cut the price, by the way, in June, only a month later, if they were going to cut the price at all. But they cut it 40 grand, 45 grand, and nothing happened until 2 weeks before Christmas or 10 days before Christmas. And boom, it went under contract pending, and it sold for 1.12. So actually not a horrible discount from the original list price, and they didn't cut it that badly. They probably knew what they had, which is a fantastic property that will likely continue to see strong appreciation due to the Aspenization of Nederland. I'm a huge fan of Ned. I used to go up there on Wednesday nights to a bar called the Wolf Tongue and play the open mic nights up there. I really preferred it a little funkier, to be honest, than turning into Aspen, but it is going to do what it's going to do. We can't, standing in front of the market and trying to stop it from changing is like standing in front of a moving train. There's nothing you're going to do that's going to stop this market from Aspenizing. So if it's going to Aspenize and increase in value anyway, and you're going to see a lot more higher end restaurants and boutiques showing up there in the next decade or two, you might as well get in on the action if you can afford to.
Yeah. Thinking of our Shady Hollow listing, now that we're in Nederland.
Yeah, that property was interesting, but this property has a better location from an accessibility perspective to the town of Ned.
Big time. Yeah, Shady Hollow is your getaway, and this is your ski cabin or your, get out there with your friends.
If you want to hold hands with your sweetie and walk into town and have a few drinks and have a nice meal, you can walk back in the dark, right? Like you could actually not need a car and enjoy Nederland, and that's something special.
No, absolutely. The Barker Reservoir is, I think you're completely right. As it Aspenizes, as it grows, this property is going to increase. Yeah.
Yep, great choice.
Mm-hmm.
All right, I think that is the end of our segment for Sales of the Week. In the news, just hot off the press, Boulder has announced that they are looking to sell the North Boulder complex. This is the city of Boulder selling, actually, I thought it was Boulder County. That's what's confusing. I need to double check that. No, it's the county, it's not the city.
Yeah,
so the county owns this enormous portion of land.
17 acres, 17 and a half acres.
Yeah, and for a long time, I've always bicycled by it and wondered, who is officing here? Why does the county own this land? And what's going on in this complex? 17 and a half acres is an enormous chunk of land. And so they have it on the market. Well, they've said they're going to sell it. So this is sort of an invitation for developers to make an offer. And the amount of potential in 17 and a half acres is enormous. Hamish, what's your hot take?
My hot take, I'm not super familiar with the area, and I'm wondering if some of those existing structures can be saved. Looking at it from satellite view, it looks like there could be something cool there already. Is it the baseball fields as well?
Yeah, it includes the baseball fields.
Those can go. Baseball, I'm not a huge fan, but
well, let me. Yeah. So if you're driving north on Broadway, this is, it's on the corner of Iris on the east side of Broadway.
Yeah, I'm checking it out. I don't know. I know on the opposite side of Broadway, just up the road ever so slightly. Actually, right there on Iris, they're doing some higher density, like row home type of developments.
Right. That's right.
It could be cool for a little shopping spot. It's kind of some smaller retail would be neat there. I know like there's the Lucky's Market a little bit more north, but there's a bit of a desert between Pearl Street and Lucky's, so it could be cool, and that would serve maybe Newlands and that little higher density spot.
There is a shopping desert between Ideal Market and Lucky's, for sure.
Yeah.
This could support
Ideal Marketplace.
This could support some really cool retail, but I'm pretty sure they're going to bulldoze the whole thing and build mostly housing. I doubt they're going to retain any of it. And the developer, it could build something very similar to the Armory, with a mixture of single-family homes, apartment buildings, and only if it's zoned in a way that required or encouraged mixed use, I think, would you see stuff like that. But it would be a great spot to also have some mixed use. And
it would.
How it's all about profit for a private developer, but the county. So the county is, I don't know if it's the county or the city that controls the zoning of it, because this may not be annexed into the city.
There's that little unincorporated section, right?
It could. So you see this sort of patchwork throughout the city of Boulder, where there are little parcels and neighborhoods that are technically not in the city. So it could be the county that controls the zoning on it. It's not entirely clear, and it really doesn't matter. It will be rezoned so that it allows for redevelopment, but what that redevelopment looks like is still, completely in the air, right? This is a brand new announcement. This is an article from today, and so
hot off the press,
right? This is the county said. I don't know who they're quoting, but the county said the North Broadway site has sufficient land and could be configured in such a way as to create a node along the North Broadway corridor, while also providing affordable housing. Of course, you always tip your hat to affordable housing.
Must.
While it still remains to be seen if the surrounding community would support such a development, the potential of the site is very strong. And on Tuesday, the county said that, quote, after careful consideration, Boulder County will not pursue continued ownership and redevelopment. But a county spokesperson told BizWest that a potential buyer or a type of buyer, an affordable housing developer, for example, has not yet been identified. So the county said it plans to submit a land use change request for the property during the 2025 Boulder Valley Comp Plan update process. So that's when the zoning change will occur. But in the meantime, it may be a bit of a scrum. The usual suspects, Coburn and Boulder Housing Partners, typically win and have been, it's so common that it almost makes me suspicious of some sort of corruption going on. Like, why is it always Boulder Housing Partners? Why is it always Coburn? And it would not surprise me if a project of this scale ends up being those two entities yet again.
Yeah. A super valid point, right? I'm clicking around. I'm on Street View, running through it. They've got you can go through the parking garage or parking lots and everything. Huge piece of land. Yeah. I've driven by this a ton and thought nothing of it. But
whatever they do, I really hope they fix that corner, because on a bicycle, so they're going to do some sort of realignment on an Iris. What the plan is, last I heard, is they're removing a lane. And they're going to create a bike lane there, and so it's going to be more constricted for vehicle traffic and easier to go east-west on a bicycle. But having ridden that many times as I rode my bike to the office or to when I lived in North Boulder, that corner sucks. That corner is really, so I would cut through the parking lots to get onto Broadway rather than get squished in with the cars at the corner of Iris and Broadway. And it would be really nice if they actually allowed some sort of bicycle path through that development, and however it's designed to create safer access for pedestrians. But who knows how it's going to play out? It's probably 5 years away, but expect it to change dramatically and say goodbye to your ball fields.
You can expect us to continue to cover it on the House Einstein podcast.
Absolutely. And we'll continue to talk about it. Right now, all we have is hot takes, because this is right off the press.
Hot off the press, yeah. Perfect.
And in our next piece of news, the Wall Street Journal had a very interesting piece today on how to negotiate a real estate deal and actually get what you want. And it's sort of funny, because yesterday I recorded a little 3-minute video warning buyers that you really need to know what game you're playing. And the game could be that you want the best possible house for you and maybe your family, or the game could be that you're trying to get the best possible deal and get a really, really good investment. And the Venn diagram for the overlap between those two is very narrow. Even it's bigger at the high end. It's pretty much non-existent at the entry level. So if you find the right house at the entry level, even into the mid-market, and you want to negotiate aggressively after you found the right house, as you're thinking about writing the offer, suddenly you get this negotiation bug, you better be ready to lose the house. And this article touches on a lot of the same themes. Like sometimes people are their own worst enemy in negotiations, and it's absolutely worth reading. We were providing a link to the article in Realtor.com, which is the same as the one published in the journal. And it's full of some interesting tips. It's sort of elementary too. It's not that nuanced, but it's really helpful if you're shopping for real estate to think about your goals and to be really clear on your goals. And it's also really common for people to miss the first house they really wanted to buy, the one that got away, because they decided at the last minute they really wanted to get a good deal on it too. They wanted their cake and eat it too. And that's a really uncommon thing. Although at the high end, it's a different game. And this article talks about some higher end sales, although one of the price points they talk about, isn't even remotely high end for Boulder, but it's worth reading the article if you're getting ready to shop for real estate.
Absolutely. We're getting there on time, but when I was searching for a home, I'm almost glad that rates were a little bit lower and there was, say, even more competition, because I learned this lesson the hard way quickly. And then my next offer, I included things like an escalation and some pretty tight deadlines and tight language around inspection to ensure that I got the home. But now where it's kind of a little bit more selection and you're not 100% certain if the house is going to fly off the market, you start to think, well, maybe I can scrap a little cash or save a little under the list price. And yeah, I did not have that option during the market that I was buying in.
And I remember you thinking that rates are going to go down. And
I still check them like they're going to.
Right. And you're feeling bad about the rate you're getting, even though you ended up buying down the rate quite a bit. And now it looks prescient.
Yep. Yeah, we're not going to be touching that rate in a long time.
Yeah, that's right.
That's the news. It's your turn.
It's called Carveout. This is a segment where we allow ourselves the opportunity to talk about anything we'd like to talk about. Because why not? Let's have fun. And in this particular pod, I'm just going to talk about an upcoming trip. I'm actually really excited about it. In a few days, I'm going to be traveling to Florida to visit my parents, who are now my mom's in her 80s. My dad's about to turn the corner and hit 82. And I'm sure many people have this experience, and you're fortunate if you do, that your parents have reached an elderly age and you're not sure how many more years you may have them. And so I feel very lucky and very grateful for the opportunity to go down there for a couple of days and connect with them. And also that we live in a time period that I'm literally going to bring my office with me, right? Like I will have my laptop, I have my cell phone, and visiting my parents involves a lot of sitting around and eating. So I will have a lot of time. Also, if I need to do any work, I can easily write contracts and negotiate deals. And of course, the best team in the business to help handle stuff on the ground here in Boulder, should I need it. But really the sweetness of this is the opportunity to spend time with them. And I've been talking to my siblings about doing another little video for posterity, for having a record of them, to ask them questions about things like their childhood and what their schooling experience was. And in particular, I never really thought about this very much as a child, but I think about it a lot as an adult, particularly when I notice some of the challenges our clients have when they move to Boulder from a place outside of Boulder. They're meeting new friends, they're establishing new relationships, creating new circles. And when my parents moved here, my dad was very busy with residency, and my mom was basically home alone with the kids in New York City, not having grown up speaking English as a primary language, with massive culture shock in the early 1970s.
Oh, it's 70s New York. I was going to ask, yeah.
No, 3 television channels and no cell phone. And, she must have been really lonely. And it must have been incredibly hard. I remember the letters that she used to write on airmail back and forth to her parents and her sister and brother. And today it's like instant, we can have a video call anywhere in the world, but we didn't have those things. And yet still people struggle to acclimatize to a new place. And as a kid growing up, I never really thought about what her experience was. And now I really want to ask her the questions so that I can learn about what that was like for her as a human. And also have it, hopefully as a little video, we can share with our nieces and nephews and other family members, so they also, their grandchildren can
Living
also,
record, yeah.
And can also, when they care. So
there's a good point there.
we don't have kids, but we've got 12 nieces and nephews, and they're at this age where I don't think they care. Like, they're very all about them, which is fine. That's the age they're in.
I've been there. You've been there, right?
Of course. That's why I'm speaking from experience, right? Like,
Yeah.
Was I interested in my grandparents when I was 12? No,
Yeah.
not at all.
Yeah.
And as a friend of mine put it, like, the only thing his daughter is interested in is if Taylor Swift is somehow involved. If Taylor Swift is not involved, she's not interested.
Don't talk to me. Yeah.
So someday they may be. And I think it sort of clicked for me in my 30s with my grandparents that I'm really curious about their life experience. And I guess that comes with your awareness of your own mortality. Anyway, I'm super excited to go spend time with them and then attend a regional event called Love Burn out in Miami with our Burning Man camp. Half of my camp is going to be there. It's a short event. And because I can't get this service mentality out of my genes, I'm rangering Burning Man, both Burning Man and this regional. And the organizers for the regional asked me to do 2 shifts, which means 12 hours of volunteer time, 12 hours of volunteering to not be the cops, but try to keep things from spiraling out of control, and attend to issues before they become law enforcement matters.
Yeah.
And we have radios, and we walk around trying to be the eyes and the ears and the facilitators of the event, and keep people safe, and sometimes trips at people if that's what's happening in the moment. It's a fun job, but it also is a lot of work. So anyway, I'm really excited.
It is a job, yeah.
What's that?
It is a job nonetheless.
It is a job.
It's fun.
I'm really excited to go out there for that. I will also have my laptop and my cell phone and the ability to communicate, but slightly less available during Love Burn. Although we have so many deals under contract, I can't be unavailable. I have to pay attention to what's happening. And gratitude to you, Hamish, for your being on the team helps make it possible that I can get out of Boulder every now and then.
Oh, of course. You're covering for me on my Arizona trip, so we're good there.
That's right.
Yeah. Is it on the playa? Is it on the beach or?
It's on the beach. Yeah.
Oh, cool.
It's right in Virginia Key.
The playa.
It is technically playa. It is on Virginia Key, and it is right next to the water. And the weather this week and next week looks perfect. So,
Awesome.
Yeah, it's gonna be good.
Come back with a tan.
I always have a tan.
Yeah, redundant. Come back with one. Should I jump in?
Please. What's your Carveout?
Yeah. I wanted to talk about cars. Because Carveout. Last year was my big push for that all-American road trip type of deal from Denver to North Carolina. And so my big push was to get this car that I had V8 swapped and built myself kind of more road tested and ready for the road trip. But this year I've got quite a fleet, and they're all inexpensive cars that I'm putting a lot of work and money and time into because
the hoopty
that's
fleet.
How I enjoy it. Yeah, the hoopties. So I've got a SUV. It's a Pathfinder 95 that I got for $300, and to get it roadworthy and everything, I'm $700 all in on it. And it's got some nice off-road tires and stuff. It was a good deal, but that's going to get a little bit of love this year. The most exciting one is it's kind of a family car at this rate. My first car was this 1995 BMW 7 Series. It's a 740, the V8, and I won't get too technical, but my grandpa got it from the original owner a year after he bought it in 96. This is like a car, I think, adjust for inflation, it's probably around like 130 grand. I think it was 80 MSRP in the time, and he bought it from the owner for 20 grand the next year. So the owner is Richard Carver, who was the assistant secretary for the Air Force, I believe. Really odd story and everything, but it's been in the family for a long time now, and it was my cousin's first car, and she wasn't technical or anything or mechanical, so it kind of went into the ground. And then when I got it, that was like my big spark into the BMW community, classic cars, and also just being able to work on them. So I had it for a long time and kind of also drove it into the ground after fixing it up. This year, the goal is to bring it back, and I'd love for it to become the daily. So it's mostly physical. Over my course of ownership, I've replaced damn near everything that can fail mechanically. Knock on wood here. But yeah, this time around, it's going to be kind of sorting out the interior. I've got some new seats to put in. New to me. Everything here is used. I've got some new to me body panels to put on. I'm going to have to look into prepping it for paint, sanding it down myself and everything, and then I'm gonna outsource the paint job, but I'm gonna explore cheap options like Mako or somewhere. And I've heard that with Mako, if you do a lot of the work, the prep yourself, the way it works is they've got maybe 8 hours to prep and paint and finish a car, but if you do the prep, then they have 8 hours for more caring about the paint quality or more caring about X, Y, and Z. So if you offload some of the labor from them, they'll give you a higher quality job at the end. That's rumor, but I'm going to give it a shot and wear as many respirators as I can. But no, it's a cool car. It's I think it was in Goldfinger. It was James Bond's car. It's a gorgeous vehicle. If you think cars are pretty, I really like it a lot. It's a short wheelbase version, so it might as well be a 5 Series, but it looks so much better. And it's got the reliable V8 of the generation of that 7 Series. So knocking on wood for all of the things that I may have jinxed myself for, but I'm really excited to get that going. It drives great. It's quiet interior. I've got this Hyundai now, and yes, it's good on gas, but it's just, I mean, you come from a 7 Series, it's just not the same,
I would argue that it's the best looking 7 Series BMW's ever produced, because after that they went to the bubble butt ones that look horrible. Yeah. And then I don't know what they did after that, but they just got unreliable and the design philosophy in the mid 90s is when BMW and Mercedes were producing over-engineered cars, and that one, I wouldn't say it's 130, it's like 160 or 180,000 today if they were to sell a car like that.
And that was before 2020 that I was, so yeah, without a doubt, I think with inflation. But that's, dang, I even forgot the designer of the 7 Series we're talking about. The bubble butt, the bangle butt is just notorious. And after that 7 Series was released, this one actually went up in value because everybody hated the new one so much. And yeah, I gotta agree. I think they're just strikingly good looking cars. So yeah.
Well, my only request is don't sell the daily until you've been driving this one every day for at least 30 days, because there's a danger of our peak season overlapping with the Hoopty becoming the daily. And I'm like, hold up.
Not going to happen. Don't worry about it. Yeah, I think I'll probably have the Hyundai for this year, in all honesty and kind of realistically thinking. Yeah.
Cool.
So it should be good.
Nice.
Yeah.
Well, folks, I think this is a great stopping point if we're going to wrap this up under 2 hours. And we deeply appreciate you listening to the House Einstein podcast or watching us on YouTube. Although watching us talk to each other for 2 hours, I'm not sure why that would entertain you, but it might. If it does, thank you.
And we're flattered.
We're also deeply appreciative of the new clients we've gotten from the podcast, as well as all of our listeners that have left comments and have given us encouragement to keep going. We hope this has been enjoyable for you too. And if you are looking to find us, you can find us at houseeinstein.com. You'll also find a sign-up link on that website for our monthly newsletter. That's the only place we talk about active listings due to real estate rules and regulations. So if you really want the skinny on what's currently listed, we, once a month or so, will put out that newsletter. Or even better, if you want the real skinny because you're shopping, pick up the phone and call us. We'd love to talk to you about becoming a client of the brokerage. And with that, I think we'll leave it. What else do you have to say, Hamish?
Oh, take care.
Take care. We'll catch you next time.